Hey everyone, hope you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it together, generally related to three different topics: wealth building, commodities, and/or financial topics. Let's dive in there and take a look, see what is going on. If you want to follow me at @Finance, and if you want to join our community, finding-value.com, where I dive deeper into all of these topics and subjects, looking for potential investment opportunities and sharing those opportunities with everyone in the community. We've got a special going on. Special is the coupon code. You can get savings on a monthly and yearly membership if you'd like to join. I provide a Q&A session during the weekend, midweek updates on what I think looks good in the market. They are done through videos, and I talk to the charts for the midweek updates and share my opinions on other things, perhaps about the companies that I like and maybe why I like them. Starting off with Logan. So Logan says, Lord, no. And that's exactly what I say when I see Reventure Consulting's stuff like this. Um, I, I started laughing pretty hard when I first saw this because basically what pops to my head is exactly what pops into Logan's head. This guy's ridiculous. Just absolutely ridiculous. Of course, he's trying to hit the fear button. He's trying to get everybody to click his links through fear. And again, Lord, no. And this is your new competition as Reventure Consulting is putting in all of this information. Just be careful who you listen to. I do not think that this guy is correct. He's been calling for a crash forever. He is the Harry Dent to the stock market is like Reventure Consulting to the real estate market, calling for a crash nonstop, always. It's not like we entered a super cycle in commodities that started in 2020 and someone's bullish from 2020 onwards in a super cycle. If you look back at history and you look at a lot of the data, we've really only had a couple times in history where, on a nationwide basis, we've had a pullback in real estate. And those few times were basically a bunch of bad loans into the system. So all you have to do is say, do we have a bunch of bad loans in the system that are going to go foreclose? In my opinion, at least looking at the data, the answer is no. And all of this, I mean, we could have pullbacks in certain cities for sure. And the supply in, say, maybe Austin and certain cities in Florida and maybe Texas very well could pull back to some degree. But we don't have the foreclosures, at least not yet, mounting up with a bunch of bad loans where we're going to see a slew of inventory coming from forced selling. I don't think we see that. Just in, Bitcoin is not quantum proof. Quantum computers, that is. Google researcher says. The study shows it now takes far fewer qubits to break RSA encryption, which is used in some crypto wallets. Bitcoin uses ECC, but quantum tech can break that too. It looks like Bitcoin's not as safe as what most people think when quantum computers start to get fired up. I can tell you what is safe: gold, silver, platinum, palladium. In fact, I think the demand for some of these materials could go up substantially based off of quantum computing. And I also think that there's abilities for the doping of materials together to make them even better. Something like a platinum silver mix could do something that might be crazy, where you get the robustness of platinum and the temperature of it and silver's conductivity. That would be a pretty cool mix. And I do think they are working on certain things with contacts and maybe some other things out there where they start to play with materials for longevity, for its conductivity, for kind of the combination of those two things. Steven Straza says this 20-year base in U.S. steel just needed a little Trump pump. I think it goes a lot higher from here, and that is the United States Steel Corp. I can see that that's trying to break through resistance, and maybe we get a run. One of the things that I first did is I usually like to look at the charts myself, so I pulled up X, and then I started looking at its valuation, and it's like, man, this thing it's pretty richly valued, is what I'll say. I'm not saying that it can't go higher. It definitely and easily could go far higher, but I wouldn't say it's a low risk opportunity. So I know a lot of the technical guys, they look at resistance levels, support levels, and they don't look at the fundamentals of the company at all. I'm a hybrid. I'm a hard hybrid. I look at the fundamentals. I want to see valuation. I want to see alignment between the fundamentals and the technicals. You can have the technicals look great and it can still go up, but the fundamentals could be overstretched. And that's where I kind of pull back. It's like, you know what? That's kind of risky. Because if the technicals don't play out the way that is planned, it could easily reverse on you, and you don't have valuation at your back. It's in your face. So I tend to shy away from things when they are a little bit more expensive. Now, the difficult thing about commodity companies is that the price to earnings ratio could look overly rich. But their earnings could grow dramatically in, say, a year or two. You could easily see in some of these companies their earnings grow by thousands of percents. And that's the whole reason that people are drawn to the commodity sector, is that their earnings could grow thousands of percents. Now, if their earnings could grow thousands of percents based off of commodity prices going up substantially, or the services that a service company offers, like day rates of something, well, that also means that their price to earnings ratio could swing dramatically in both directions, depending on where the commodity price goes, which throws in a wrench to the fundamental analysis of some of these commodity companies. So you might need to not focus on, say, a price to earnings ratio. You might need to focus on other metrics where they're a little bit more solid compared to history, is what I'll say. They're a little bit more predictive, or a little bit more predictive of valuation, is what I'll say. The Kobayashi letter says, breaking, the median U.S. mortgage payment jumped about 5% year over year in May to a record of $2,882 a month. Over the last 3 years, the median home payment has risen by $580 a month, or 25%. This comes as home prices rose 1.7% year over year to $392,000, near the highest on record. The record housing payment also assumes a 30-year fixed mortgage rate of about 6.8%. Meanwhile, pending home sales declined minus 2.2% year over year to their lowest level in data going back to 2015, according to Redfin. Home ownership is becoming even more of a luxury. And this is home buyer housing payments are up 5% year over year. The mortgage payment on the 4-week rolling average of the median asking price. Now, back when I purchased a house in the 2010s, I was deathly afraid of what is transpiring today. It became very obvious after 2020, is what I'll say. So when it was in the mid 2010s, and I was looking at purchasing homes, there was still a lot of home buyers, and there was many offers on each house in the mid 2010s, even 2015, 16, 17. There was a whole bunch of people looking at homes, putting in offers, and it was heating up pretty good during that time frame. That's when I realized figured out the real estate cycle, that I wanted to get in pretty bad and lock in my mortgage rate, lock in the costs. And if you're a buyer, your mortgage payment will never be more than when you locked it in as long as you've got a 30-year fixed rate or 15-year fixed rate mortgage. It'll never be higher than that. But you can always refinance in the future. So I was looking at homes. I purchased a home and I refinanced in 2021 at a very, very low rate. And that's how I did it. And I got my mortgage down quite a bit. I mean, it is way down there. I did a 30-year fixed rate mortgage at 2.75%, and I'm not going to pay mine off early. Now, that has changed from 2020, 2021, where it bottomed and started coming on up after 2021. So mortgage payments are going up, and this is exactly what I thought would occur. I didn't know when, but I figured that we could potentially get a slowdown late 2019, 2020, where I could refinance. I refinanced, and then I was worried about interest rates going up substantially. Now, here's the weird thing. What's the replacement cost of a lot of these homes? What's the new build costs for equivalent homes that people live in? And if the equivalent cost keeps going up and up and up of new homes, there might be a point where home ownership is a luxury. And the regular people, a lot of medium home buyers will call it, the median income is going to struggle to purchase it. So, and that's only because of how much it costs to build a new house. So if you don't have a lot of new homes being built and people can't afford them, then I would assume that maybe there's less new homes that get built out in the future. In the short term, though, they're still affordable. They're buying down the rates to make this affordability a little bit better, and they're still going to push, I think, homes onto the market, new homes. But if rates continue higher, it's going to put pressure on these payments. Patrick says commodity bulls need to face the truth. Other than gold and coffee, you would be hard pressed to find any other that is outperforming the stock market. It is just that early. Eventually, one by one, they will outperform, but not now. What is this guy? Is he calling does he know that they're just not bottoming? That we're going to go sideways? I think this is kind of premature to kind of act in this manner, like, oh well, it's not gonna outperform. I'm in the opposite camp. When you see something that is an incredibly good deal, I jump on it. And then I wait. I wait on it, and if it appreciates out in the future, perfect. That's exactly what I thought. A lot of people don't like the patience thing. So what they do is they wait for things to break out, and it becomes very obvious. But once it becomes obvious, you're probably 100, 200, 300% off the bottom already. So it's a little bit different type of investing. If you, in my opinion, the better someone gets, the closer they can get to the bottom of buying the absolute bottoms. And the technical analysis guys and the ones that wait for the breakouts, you'll never buy the bottom. But they'll say, well, you might be early, you might have to wait a couple of years. And I completely agree with that. But if your outperformance, even after waiting a couple of years, still beats the breakout strategy, then I would choose the strategy that returns the most with the least amount of risk. So if you're buying it with the least amount of risk, and the way that I define risk is a company that trades far undervalued, then you buy it where you have the best risk reward and the most asymmetry. Even if it takes a little bit longer, your strategy needs, in my opinion, to incorporate that patience. If all you're doing is buying breakouts and you don't know anything about the company at all, that seems really risky to me, because you don't know if you're buying an undervalued company, an overvalued company, a cash flow versus a non-cash flow company. Basically, you're putting the blinders on and just looking at what the herd is accumulating or not, without understanding the underlying risk that the business has. I see that as very risky. That's why I'm a hybrid investor. I can't just go out there and buy chart pattern breakouts. I just can't. It's not ingrained into me. Like I just can't do it. I need to know something about the company. I need to know if it's cash flow or if it's non-cash flow speculative, and that determines my position sizing. So all of these things are interconnected. I want to know what the company's future looks like to some degree. I want to know if it's run by good management. I want to know if the patterns look good. I want to know all of it. I think it increases the success rate over time of the investor. So I incorporate all that into the strategy, and that's where I get the hybrid name. The three pillars: technical analysis, cycles, and ratios. Those are the three pillars that I operate under. But that doesn't talk about fundamentals necessarily. Valuations of a sector is important, and that's where all three of those will get you in the right location. But portfolio allocation and looking at companies on how to sift through all of them, it's not just the technicals. I want the fundamentals to be good behind the company as well, and the sector, obviously. Coming down to Phenom Group, it says the final leg of soon to be a 43-year secular bull market in the S&P 500. David Hunter warns the final melt up to the S&P 8,000, then an 80% crash. So that's what he's predicting. So he's predicting, and I don't invest based off predictions, but this is his prediction, that we're at the final melt up of a 43-year secular bull market. And, I could be convinced of that for sure. Easily be convinced of that. I don't put price targets on anything. I the 80% crash, I don't know if we're going to get that big crash. We very well could. It could be driven by interest rates. And then what everyone's going to say is they're going to say once it crashes, interest rates will fall and blah, da, 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 da. Just like it happened over the past 40, 45 years. We'll see. We'll see what happens there. If interest rates go up, I think we could get into pretty high inflation where maybe interest rates don't fall like people expect. Maybe they do, maybe they don't. Silver Degen says, I can't take it anymore. I'm done. I'm out. I'm selling all of my silver. The market volatility is straight up crushing my soul. Buckle up because one day it's mooning to 35. The next it's crashing to 32.50. Like it's playing jump rope with my sanity. I thought stacking those shiny bars would make me feel like a king, believing silver was the linchpin that bring the American banking sector to its knees faster than a margin call. But now I'm just nervous wreck checking charts every 5 seconds. I'm not a revolutionary. I'm a human with bills. This roller coaster's got me dizzy, and I'm done riding it. Buckle up because I'm liquidating every last ounce, buying some stable coins, and maybe a nice comfy pillow to cry into. The silver market, you win, I'm out. That's weird. I don't. So guys, when I invest, I don't feel anything like that. Um, I don't feel like I'm a nervous wreck. The only time I get nervous is when I share my opinions and I get nervous about other people because I want them to be successful. I want people who follow me to be successful. I want them to feel what I've felt in some of these markets where you get these 10, 20, 30, 40 times your money and the returns that can potentially change someone's life. That's what I hope for every subscriber that subscribes to the website. But personally, I don't feel at all like that. It could be a function of conviction and what this person knows about silver or doesn't know about silver. And this is the difficult part about comparing, I'll say, opinions on YouTube. Some people will say, well, what about this guy over here? He has an opposite opinion of myself. And then there's other people that might have differing opinions from me and the other guy. And the question then becomes, well, why do these quote experts or people who follow the markets, why do they have differing opinions? They're looking at data, potentially the same data, and drawing to different conclusions. Why is that the case? Well, some of the cases could be the time frame that we're looking at it. I look at almost everything from a mid to long-term time frame. That time frame is measured in decades and is measured in years. Most everyone else in the market, almost everyone, are looking at it from days, weeks, and months. So what I'm trying to do is I'm trying to take advantage of the people looking at the days, weeks, and months and who feel like this guy does, liquidating their stock or liquidating their holdings in certain sectors, and I'm buying it. The reason I take the opposite approach is that I take the metal off of the people who are acting like this, the ones that are sick of it, the ones that are afraid. There was a guy up north, and he was selling everything that he had in his entire stack. Silver and platinum was mainly what he held. He had a couple ounces of gold, and he was selling it all. In fact, he purchased his platinum towards the top of the market. I think it was towards maybe not the top, but it was like 2011 when he purchased it or something like that. And I was buying it in 2021, about 10 years later. And he's like, I'm done with this. I am so done. And he was liquidating all of it. And I purchased all that he had. I said, you know what? I'll buy every single ounce that you've got. Just give me time. It took me about a year and a half, maybe 2 years to completely clean him out because he had a good holding. I bought everything at spot price, all of it. Some of it was even below spot because he really wanted to get rid of it. What he was doing with it, he was buying stuff in the tech sector specifically. So he was buying all tech. I was buying all the metals during this time frame, and I cleaned him out. I cleaned out all his platinum, all his gold, and all of his silver. And he had a good chunk of silver and a good chunk of platinum. So he was very much in the feeling like this. He was sick of it, just done with this crap, wanted to get rid of everything. And then when I was buying it from him, he asked me, he said, Andy, well, I don't know if he used my name. He said, do you really think silver and platinum are going to go up? I said, yeah, they're going to go way up. Why do you think I'm buying it? So I'm in the camp. I look at the charts. I don't look at price and get influenced by price movements. I get excited by chart patterns, in particular, a 45-year cup and handle chart pattern on silver. And I think I'm going to ride silver maybe for the rest of my life. Is a possibility. Maybe I'll swap it to something else if something gets overpriced versus it's underpriced right now. So I'm extremely, extremely patient, and long-term investing is exactly where I should be. And once you figure out what the strategy that best fits you, I'm a long-term guy. You just take advantage of people that act like this, that get scared. And yes, it does require conviction. It does require that you know the big long-term charts. It does require that you know that something's cheap. And once you figure out that strategy works, then you go all in. You go all in on the strategy. That's what I've done. That's where I became a hybrid investor. I don't think technical analysis only is strong enough. I use technical analysis to build a macro case to identify where we're at in the cycle. Once I figure out where we're at in the cycle, and I've got further information of confluence, of cheapness and undervaluation and stuff, then I start going all in on a few sectors, and I can put all my money to work over time in 6, 7, 8, 10 different ideas that are all undervalued. And it doesn't happen all in one shot. It happens over months. So you get these windows of opportunities to accumulate. And that's when I accumulate, and I just sit and I wait. Everyone else can't do that. They can't take the gyrations. And I hate to say it, silver's not even that bad. There's other sectors that are worse than silver, but most of them you get these big, 30, 40, 50% pullbacks, and they happen quite frequently, unfortunately. It says, lots of laughs. Silver, anyone? Hello, McFly. Anybody home? Cheap silver is a sick joke. The Western banksters are handing silver over to China as China loads up the vaults with silver. Eric Nuttall says, it says, why do we think OPEC plus spare capacity is less than consensus believes? And therefore, the timeline to its normalization faster, adjusting for month-over-month dip in Brazilian exports. OPEC plus net exports are only down 1.2 million barrels per day versus 2023, the highest recent May level. It says, we remain bullish over the medium and long term given peak non-OPEC production. 2028 normalized OPEC spare capacity in about a year and many years of demand growth ahead. So yeah, we'll work through that spare capacity. 2025 will probably be a slower year. Beginning of 2026 could be a slower year, and then I think it'll speed up summer of 2026. And that's where I think things will start to get moving quite substantially. Now, all of that is already priced in the stocks. So I think the stocks are bottoming. That's what I think in the oil space over this next, say, 3 to 6 months. Freight futures AM update, dry bulk, Capesize and Panamax are both down 2%, and tankers are both down about 2-3% on VLCC and Suezmax. U.S. crude exports are down 750,000 barrels per day year over year. Can you feel the energy dominance? Look at those exports decline, baby, decline. Michael says, many people will lose their well-paid jobs. Investment bankers, lawyers, consultants, accountants, doctors, designers, architects, and others. It will be brutal, folks. Buckle up. So Goldman Sachs CEO David Solomon says, AI can now draft 95% of an S1 IPO prospectus in minutes. A job that used to require a 6-person team multiple weeks. The last 5% now matters because the rest is now a commodity. The AI effect at its finest. Here's my question that I have. If AI is going to be so great, and if we lay off so many people, who the heck's going to buy these products? How are they going to get income? Because, just in this example, it's saying that, we could lay off 6-person team, kind of, to some degree. That took them multiple weeks, and now we can do it in minutes. Well, if there's that much efficiency that actually is gained, well, that means we could get rid of a whole group of people. And if we get rid of a whole group of people, who the heck's going to buy the products? How are companies going to grow if you get an unemployment rate that's like 40 or 50%? Seems a little bit confusing to me. And I don't think people who work with their hands will be impacted, but I do think people who work with their minds, white-collar jobs, could definitely be impacted. And that could be impacted around the entire world, not just America. U.S. stock markets are now more expensive than nearly any time in modern history. But here's the real problem. U.S. households are holding more stocks than ever before. This combo is rare and risky. And one thing to look at the S&P 500. It is the most expensive that it's been in a 20-year time frame. So we're way up there. The Russell's kind of more towards average. And then the NASDAQ is more expensive as well. So yeah, we've got some overvalued equities in relationship to history. Market is risk off, so a staggering 7.25 trillion is now sitting in money market funds, a new all-time high. You know what this is? This is all jet fuel for the future. But as you can see, it continues to go up and up and up for money market funds, total financial asset level. This is Logan. I thought this was kind of interesting here. He says, read the census new home sales report at least once. It will set you free. You need to find better friends who aren't constantly pessimistic too. Don't waste your life with doomers. And this is new houses for sale by stage of construction, not started homes are, it's rocketing higher, which is interesting. New homes for sale by stage of construction not started are rocketing higher. That is, I wouldn't have guessed that. Jordan says, ignore the crash calls. They get a big audience, but also demonstrate a lack of understanding about the current macro market picture. In a nascent secular inflationary era, higher bond yields eventually lead to the end of the secular bull market in stocks. I totally agree with that. In 1966 and 68, it was the 10-year yield breaking out of a nearly half-century base above 5% and eventually hitting 5.5%, which killed the secular bull market in stocks. I don't know what the yield level will be at this time, but once that is in motion, it sets the stage for an accelerated move higher in gold against the S&P 500. Much more capital will move out of stocks and into gold. And that's those big commodity bull markets where the S&P 500 traded sideways. It started to trade sideways when interest rates started to peak above the 5 to 5.5% level. That also, we had a big sideways chop in the mid-2000s as well. Big sideways chop. So I think that's what's coming next is a sideways chop. And I've heard Besant talk about holding interest rates around the 4.5% level, and that's exactly where we're at, is that 4.5% level on the 10-year yield. So once rates get above about 5%, it starts to put pressure on the stock markets. And we very well could see a rollover of the stock markets. But that's all I've got for today, guys. So we'll end it there. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you'd like. And we'll catch you next time. This is Finding Value.